this session, we are going to discuss how to calculate national income by expenditure method. National income of the country can be measured by three methods: value added method, income method, expenditure method. All the three methods give the same estimation of national income. So today our focus is on expenditure method. Expenditure method measures final expenditure on gross domestic product at market price during 1 year. Final expenditure is the expenditure made on consumption and investment. Here national income is measured at the point of actual expenditures on goods and services for final use by all the four sectors. Now they are the steps of calculating national income. First of all, identification of the economic units for incurring final expenditure. These units are household sector, producer sector, government sector, rest of the world sector. Second step is classification of final expenditure. Private final consumption expenditure, PFCE, government final consumption expenditure, GFCE, gross domestic capital formation, GDCF, net exports, exports minus imports. In the next slides, we will discuss in details. Classification of final expenditure. Private final consumption expenditure. It measures the market value of goods and services produced by the households, and then they are purchased by the households. Non-profit institutions serving households. It consists of purchase of goods, durables, semi-durable, non-durables. Direct purchases made abroad by resident household during their foreign travel is added. Direct purchase by the non-resident households and foreign tourists in the domestic market are subtracted. Wages and salaries received in kind, gift received in kind, imputed rent of owner-occupied houses, and imputed value of the production, self-consumption by the producer, compensation of employees paid by non-profit institutions serving households. Step 2. Classification of final expenditure. It is incurred by general government to satisfy collective wants of the people. For example, government expenditure on health, education, law and order, etc. It consists of purchase of goods and services in the domestic market by the government. Direct purchases from abroad, it is added. For embassy, military base, consultant located abroad, we have to deduct direct purchase by foreign government on their embassy, military base and consultant in domestic market. We have to add compensation of employees. We have to deduct sales of goods and services produced by general government. Calculation of the final expenditure. So as you can see, GDP, that is gross domestic capital formation, is divided into gross domestic fixed capital formation. It has got gross business fixed investment, gross residential construction, gross public investment, and changes in stocks, closing stock minus opening stock. Now classification of final expenditure, that is net exports, that is exports minus imports. In the third step, we are going to add all the three items, that is private final consumption expenditure, government final consumption expenditure, gross domestic capital formation plus net exports, and we are going to get GDP at market price. If in the formula it is given gross domestic fixed capital formation, then you have to keep in mind you also have to add change in stock, then you will get GDP at market price, and the rest formula will remain same. In the fourth step, calculation of domestic income, GDP at market price already you have calculated, minus depreciation minus NIT, net indirect taxes. And in the fifth step, you need to calculate national income, that is NDP at factor cost plus NFI. Now following items should be included. These are the precautions: expenditure on final goods and services, expenditure on commission on sale of second-hand goods, expenditure on brokerage on shares and bonds, imputed expenditure on own account production. Following items should not be included: expenditure on intermediate goods and services, expenditure like scholarship, pension, donation, etc., expenditure on purchase of second-hand goods, windfall gains, expenditure on purchase of shares and bonds. Now let us see numericals. One numerical is given. Now first of all we will apply the formula. private final consumption expenditure, government final consumption expenditure, gross domestic capital formation plus net exports. And we will put the values and we will add together and we will get rupees 9,550 crores. Then we have to calculate NDP at factor cost, which is being asked in the numerical. We have already calculated GDP at market price. So GDP at market price minus depreciation minus NIT, and we get NDP at factor cost, that is rupees 8,840 crores. Now in the next numerical, one trick you have to keep in mind, that is when in the question gross domestic fixed capital formation is given, then you have to add change in stock. So in the first step, we will calculate private final consumption expenditure, gross final consumption expenditure plus gross domestic fixed capital formation plus change in stock minus net imports. Now why we are deducting net imports? Because imports are minus, and we will calculate. Then in order to calculate national income, we are going to add NFIA and we have to deduct depreciation from gross domestic product at market price minus NIT to get the factor cost, and we will get NNP at factor cost, that is rupees 630 crores. Now this is the reconciliation of the three methods that already we have discussed, that is value added method, income method and expenditure method. Thank you. In this session, we are going to discuss how to calculate national income by income method. National income of a country can be measured by three methods: value added method, income method, expenditure method. All the three methods give the same estimate of national income. So in this session, we will focus on income method. This method measures national income generated from four factors of production: wages, rent, interest, profit in exchange of factor services. What are the steps of calculating national income? First of all, we have to identify producing enterprises. Here, producers employ factors of production: land, labor, capital, entrepreneur. The producer categories are primary sector, which exploits natural resources, mining, agriculture, fishing, etc. Secondary sector, which transforms one commodity into the other, that is clothes produced from cotton. Tertiary sector renders services, example banking, insurance, etc. Now we will classify factor payments. These are classifying as compensation of employees. In short form, you can tell COE. It is total amount of remuneration in cash and kind also. For example, I am the teacher. If I am getting the salary, I am getting in cash. But if I am getting other medical facilities, uniform, housing, then it is wages in kind. Employees' contribution to social security schemes. So if you add all the three items, you get compensation of employees. The second item is operating surplus. It is income from property, rent, royalty, interest plus income from entrepreneurship. So profit has also got three parts: dividends, corporation tax and corporate saving. If you add all together, you get profit. And if you add all the four items, you get operating surplus. In short, it is called as OS. Mixed income of self-employed. It means income of own account workers, farmers, doctors, barbers, etc. Unincorporated enterprises, small shopkeepers, repair shops, etc. The third step is calculation of the domestic factor income. If you are going to add all the three items, that is compensation of employees, operating surplus plus mixed income, you are going to get NDP at factor cost, that is net domestic product at factor cost. Now to get national income, that is the fourth step, you are going to add NDP at factor cost plus NFIA, that is net factor income from abroad, and you will get national income. So it is denoted as NNP at factor cost. Now we have to keep in mind some of the precautions. Now following items should be included. Interest paid by production unit on capital borrowed, imputed rent of owners occupied houses, free services provided by owner of production unit, that is implicit cost, imputed value of the fixed assets produced for self-consumption by enterprises, government and households, imputed value of free services produced by government and non-profit institutions. Now following items should not be included. First of all, transfer income like unemployment allowance, charity, old age pension, taxes paid by the production units, excise duty, sales tax. Number 2, income from sale of second-hand goods, income from sale of shares and bonds, windfall gains like lotteries, horse race, etc. are not included. Illegal incomes, smuggling, black marketing, etc. also not included. Payments like gift tax, wealth tax also not included. Indirect taxes like GST, such taxes are to be included in national income at market price but not in national income at factor cost, that is NNP at factor cost. Net domestic product is calculated as follows. So let us discuss one of the numerical. So numerical is being shown: compensation of employees, rent, wages, salaries, net exports. Now first of all, the first step is we should calculate NDP at factor cost by adding compensation of employees, operating surplus plus mixed income, and we will get NDP at factor cost, that is 1400 crores. Now you see in the numerical that mixed income is not given. Now you will, in place of that, you can put 0. Now you need to calculate national income because in the numerical national income is being asked. So NDP at factor cost plus NFIA, that is 1400 minus 20. The value is given in minus. So you have to deduct and you get rupees 1380 crores. One more thing you have to keep in mind, that always use the, for example, if the value is given in crores or arabs, so this unit you have to keep in mind. Now the next numerical, you see in place of national income, it is given GNP at market price. So what are the steps? The first step is to calculate NDP at factor cost. For that you will add all the three items, 350 plus 220 plus 100 plus 80 plus 150, and you get 900 crores. Then you calculate GNP at factor cost, that is NDP at factor cost plus depreciation plus NFIA plus NIT. What is NIT? Indirect tax minus subsidies. 900 plus 50 plus 10, that, and in brackets you will like 90 minus 20, and you will get rupees 1030 crores. So this is your GNP at market price. Thank you. Today in this session, we are going to discuss national income and how it is being calculated by value added method. National income of the country can be measured by three methods. Value added, it is also called output and product method, income method, and distribution method. Expenditure method, it is also called disposition method. All the three methods give the same estimate of national income. In this method, there are two approaches: final product approach and value added approach. Final product approach, here final product also called gross domestic product. Here GDP is monetary value of all final goods and services in domestic territory in an accounting year. It is estimated by multiplying gross product with market price. GVO, that is gross value output at market price, is equal to price into output plus change in stock plus goods produced from self-consumption. GVO at market price is also known by sales plus change in stock. That is, the goods are being produced for self-consumption. Here you have to keep in note that it is gross, thus it includes depreciation. Being at MP, that is market price, it includes net indirect taxes. Today it is called GST, that is goods and services tax. Now what are the precautions you have to keep in mind? Value of only final goods and services included to avoid problem of double counting. Value added approach. Here national income is calculated by adding net value added at factor cost. Here by adding net factor income from abroad to domestic income, that is net domestic factor income at factor cost, we get national income, and the formula is NNP at factor cost. Here domestic income is estimated at the stage of production, that is at the stage of value addition. GVA at market price or GDP at market price is equal to GVO at market price minus intermediate consumption. And if you want to calculate NVA at factor cost, that is net value added at factor cost is equal to gross value added at market price minus depreciation minus NIT. What is NIT? Net indirect taxes. Now there are steps to calculate national income by value added method. So first of all, you have to identify the production units. There are 3 production units. Primary sector, which exploits natural resources, mining, agriculture, fishing, etc. Secondary sector, which transforms one commodity into other, clothes produced from cotton. Tertiary sector renders services, for example, banking and insurance. In step 2, you should know how to apply the formula. First of all, in order to calculate GDP at market price, always keep in mind that value added method is calculated at market price. GVO at market price is equal to sales plus change in stocks plus goods produced for self-consumption. Now one more point you have to keep in mind, that whenever in the numerical domestic sales are given, then you have to add exports plus closing stock minus opening stock. So other name for that is change in stock. GV at market price or GDP at market price is equal to GVO market price minus intermediate consumption, and we get gross value added at market price. Here also you have to take in care that whenever domestic purchase is given, then you have to add imports in that. In the third step, we need to calculate NDP. NDP at factor cost, that is net domestic product at factor cost, is equal to GDP at market price minus depreciation minus NIT. Calculation of national income, that is NNP at factor cost. So NDP at factor cost plus NFIA, net factor income from abroad. You also have to keep in mind whether from is given or to. From minus 2 is NFIA, but if from is given, you have to add. If 2 is given, you have to deduct. Now, following items should be included. And here we are discussing some precautions of value added method. First item which should be included is value of final goods and services, imputed rent of owners occupied houses, imputed value of goods produced for self-consumption by producers, imputed value of fixed assets produced for self-consumption by enterprises, government and households, imputed value of free services produced by government and non-profit institutions. Now you have to keep in mind that following items should not be included: sales and purchase of second-hand goods, sales and purchase of shares and bonds, either they are new or old, production by illegal activities like smuggling, theft, etc., value of intermediate goods and services to avoid double counting, services produced for self-consumption. Problem of double counting. Problem of double counting means counting of the value of the same product for more than once. For example, there are 4 producers: farmer, miller, baker and confectioner. So let us see in the table that value of the output is given 2000, 2500, 3600, 4000, and it is 12,100 is the total. Now if a layman checks and they are being asked to calculate GDP, they will simply calculate this, but this is not correct. If we take value of 12,100, then it is due to double counting. Here value of wheat included 4 times, flour 3 times and bread 2 times. The final value of the bread is 4000 only, that is 12,100 minus 8,100 is equal to 4,000. So this calculation is being shown in the third column. So the first column value of the output, you have to deduct intermediate consumption, that is 2500 minus 2000 is equal to 500 and so on. Because in the first column 2000 there is no intermediate consumption, so the value added is only 2000. And the gross value added in the third column is 4000. So as an economic students, you should take care that you have to take only this 4000 value. Now let us also learn how to calculate by applying the formulas and doing and solving numericals. So here is the one numerical. Domestic sales is given, change in stock is given, depreciation. Now first of all, you need to calculate GVO at market price, that is sales plus change in stock. So domestic sales are given plus change in stock is given. So you get 3400. Then you need to calculate GDP at factor cost, that is GVO at market price minus intermediate consumption minus NIT, and you get 1150 crores. So you have to take care that when domestic sales is given, then how you have to solve the question. So exports have been added, this 500 value. Now in the second numerical, you see you have to calculate sales. So net value added at factor cost is given, intermediate consumption is given. So first of all we will calculate GDP at market price, that is NDP at factor cost plus depreciation plus NIT, and we will put the values 300 plus 30 plus 20 minus 10, and then after that GVO at market price, that is GDP at market price plus intermediate consumption. Finally we calculate GVO at market price, that is sales plus change in stock. So in the previous question you have seen that you started from sales plus change in stock, but this formula is coming in the end. Why? Because here one item that is missing, that is sales. Okay, so that's why we started with the GDP, and net value added at factor cost is given. So this is the way to calculate the sales by this value added method. Thank you. Today we are going to study national income aggregates. Under this we are going to study basic terms, micro and macroeconomics, stock and flow, classification of goods, meaning and types of investments, depreciation, capital loss, domestic or economic territory. National income meaning, ways of calculation, some more key terms like NFIA, transfer payments, etc. What is microeconomics? It deals with at the level of individual unit, a household, a firm or an industry. Simply, microeconomics is the study of individual economic units of an economy. Microeconomics is also called price theory, as theory of product pricing and theory of factor pricing fall within the scope of microeconomics. For example, microeconomic theory, law of demand, law of supply, determination of producers, equilibrium, determination of consumers equilibrium, etc. Macroeconomics, it is a part of economic theory which deals with the problems at the level of an economy as a whole. Simply, it is the study of aggregate economic units of the economy. It is also called theory of income and employment because the scope of macroeconomics concentrates on determination of level of income and employment. For example, macroeconomic theory, theory of general price level, theory of national income, theory of international trade, theory of economic growth, theory of employment, etc. Now we are going to study stock and flow. Stock variables are those variables whose quantity is measured at a particular point of time. Stock relates to a particular point of time. It is quantity measured at a particular point of time, such as capital of a business, as on 1st April 2016 was 10,000 lakh. Stock can be understood as a still photography in which camera records the position of an object at a particular moment. For example, wealth, water in a tank, bank deposits, capital, a 100 rupee note, machinery of a sugar mill, etc. Flow variables are those variables whose quantity is measured over a period of time. Flow relates to a period of time. It is measured over a specified period of time, an hour, per day, month, etc. Such as fixed investment during November 2016 was 2,100 lakh. Flow can be understood as a video photography in which camera records the position of an object during a time period. For example, income, investment, water in a stream, interest on capital, capital formation, monetary expenditure, consumption of sugar, etc. Now we are going to study classification of goods. First good is intermediate goods. These are those goods and services which are purchased by one production unit from other production units during the year for further processing during the year. For example, raw materials, example, sugar used for making sweets. Resale during the year by dealers without making any alteration by dealers. For example, sugar purchased by a grocer. Final goods are the goods which are either purchased or there is own account production for the purpose of consumption and investment are called final goods. These goods are outside the production boundary. These goods are acquired for consumption called consumer goods, investment called capital goods. Consumer goods, these satisfy wants of consumers directly. These are finally purchased by the consumer for the satisfaction of their wants, for example, bread, scooter, TV, set, etc. These can be further divided into 4 categories. Durable goods, these can be used in consumption over a longer period of time. For example, refrigerators, televisions, cars, etc. Semi-durable goods, they can be used for a limited period of time as compared to the durable goods, example, furniture, crockery, shoes, clothes, etc. Non-durable goods are used up in a single act of consumption, for example, milk, ghee, bread, vegetables, etc. Services, these are invisibles and are purchased for direct satisfaction of their wants, for example, services of doctors, lawyers, teachers, banks, etc. Capital goods, these are those final goods which help in the production of goods and services further. These can be used over and over again to produce goods and services. These have derived demand as these are used to produce goods and services demanded by the economy. For example, plants, equipments, machinery, etc. Now, classification of producer goods, we have already seen intermediate goods and capital goods. These come under producer goods. Features of intermediate goods. These are goods that are used by the producers, purchased by one production unit from other production unit. These remain within the production boundary, and production boundary is an imaginary line drawn around the production sector, signifying production process involved. The value of intermediate goods is not included in national income. This is done to avoid problem of double counting. Now the features of final goods. These goods are used by consumers called consumption goods or used by producers called capital goods. These cross the production boundary and the value of final goods is included in the calculation of the national income. Now we are going to see meaning and types of investment. Investment means addition made to the existing stock of capital during the year. It increases productive capacity of the producers. So I is equal to change in capital. Gross investment and gross domestic capital formation. The total addition of capital goods to the existing stock of capital during a given time of period is called gross investment. Components of the gross investment are gross investment, that is gross fixed investment, gross fixed capital formation, change in stock or inventory investment. Gross fixed investment counts the following. Gross business fixed investment. It is defined as expenditure on fixed assets, for example, machinery, equipment, factory building, etc. Gross residential construction investment. It is amount of spent on construction of flats and residential houses by producers, households and government sector. Gross public investment. It is expenditure by government and hospitals, schools, roads, dams, etc. Gross fixed investment, stock of fixed assets at the end of the year minus stock of the fixed asset in the beginning of the year. Inventory investment. It is change in stock of finished goods and raw materials. Inventory investment is equal to closing stock of finished, semi-finished and raw materials minus opening stock of finished, semi-finished and raw materials. Now what is net investment? During the production process, some amount of capital stock is used up or consumed. This consumption of fixed capital in the production process is called depreciation. By subtracting depreciation from gross investment, we get net investment. Now we are going to learn another terms, depreciation and capital loss. Depreciation is defined as loss or fall in the value of fixed assets due to normal wear and tear and expected obsolescence. The concept of depreciation is very important in economics to understand the difference between gross value and net value. Gross is equal to net plus depreciation. Now what are the causes of depreciation? First is normal wear and tear. During production process, the productive capacity of the fixed assets, for example, machines, tools, trucks, engines, etc., goes on declining because of its continuous use, leading to fall in its value. Example, when you sell your car, it does not fetch you the same value you bought in for 2 years before. Expected obsolescence. It refers to loss in the value of fixed assets due to continuous change in technology or technique of production. For example, fall in value of typewriters due to introduction of computers is an example of technological obsolescence. Expected changes in the demand of goods and services due to change in tastes and preferences, fashion, trends, lifestyle, etc. Expected changes in government policy. Due to the above reason, fixed assets may have to be abandoned even when these are still working in conditions. Depreciation reserve fund. Owing to their depreciation, fixed assets need to be replaced after some time. Replacement of fixed assets required a provision of fund to enable the producer to buy a new asset after the expiry of lifetime of the asset. For example, if a machine is purchased for rupees 1 lakh and its expected lifetime is 5 years, then the annual provision of the fund would be 20,000. That is 1 lakh divided by 5. The fund is so accumulated is called depreciation reserve fund. Now what is capital loss? The loss is the value of fixed assets due to natural calamities like floods, fires, etc. Unforeseen factors like war, theft, etc. Thus, loss of value of fixed asset due to unexpected obsolescence is called capital loss. Provision for capital loss cannot be financed from the depreciation reserve fund. Provision for capital loss is insurance. Now, what is the difference between depreciation and capital loss? Depreciation loss is expected loss in the asset and maintained by the depreciation reserve fund, whereas capital loss is unexpected and is maintained by insurance. Thanks. In this session, we are going to study some other basic terms of national income aggregates. Now, domestic and economic territory. Domestic territory is used in national accounting, has a special meaning and is much bigger than political frontiers of a country. According to United Nations, economic territory is the geographical territory administered by government within which persons, goods and capital circulate freely. Domestic territory includes political frontiers, including territorial waters, airspace, for example, telecommunication services produced by Reliance Communication in India, embassies, consultants, military bases located abroad, and foreign ones located within the political frontiers. For example, Indian Embassy in America is a part of the domestic territory of India. Ships, aircrafts, etc. operated by the residents between two or more countries. For example, services provided by Air India between Singapore and Japan are part of domestic territory of India. Fishing vessels, oil, natural gas rigs, etc. operated by residents in the international waters and other areas over which country enjoys exclusive rights. For example, research projects undertaken by Indian government in international waters of Indian Ocean is a part of domestic territory of India. Now, what is normal residence of a country? National income has been defined as a sum of factor incomes earned by normal residents of a country. Thus, the term normal resident is an important concept in national income accounting. A normal resident is said to be a person or an institution who ordinarily resides or is located in a country and whose center of economic interest lies in that country. Thus, there are two conditions to become a normal resident of a country, that is, her or his and institutions stay in a country should be more than 1 year. An interest of staying in that country should the economic interest lies there. That is, the resident carries out the basic economic activities of earnings, spending and accumulation from the location. The basic difference between the terms resident and citizen. A person is a citizen or a national of a country in which he is born, or citizenship is allowed on some legal criteria. A person is treated resident of a country on the basis of economic criteria. A person can be a citizen of a country and a normal resident of some other country. For example, a large number of Indian nationals have settled in USA, England, etc. as residents and not as nationals of these countries. For India, they are non-resident Indians but are Indian nationals. Now, what is the implication of normal residence? Production activity of the residents of an economic territory is national product, GNP, NNP are some examples. National product includes production activities of residents, normal, irrespective of whether performed within economic territory or outside it. In comparison, domestic product includes production activity of the production units located in the economic territory, irrespective of whether carried out by the residents or non-residents. Now, what are the examples of non-residents? These are called non-residents because these do not fulfill the criteria of center of economic interest. International organizations like the World Bank, WHO, IMF are not treated residents of any country but of international area. These are non-resident organizations for the country in which these are situated. Employees of international organizations are considered residents of the countries to which they belong and not of the international area. Workers from across the border who have crossed the border regularly to work in the given country, they are treated as residents of the country, whereas they live and not the residents of the country where they work. That is why they are non-residents. Foreign visitors or travelers visiting the given country for studies, medical treatment, recreation, or take the part in sports, cultural events, etc. These are non-residents of the country they are visiting. Foreign staff of embassies and members of foreign armed forces located in a given country, the crew of the foreign ships, aircrafts, etc. Now, what is the importance of domestic territory and normal resident? The concept of the domestic territory and normal resident are very important to differentiate between domestic product and national product. Domestic product includes goods produced by production units located in the economic territory irrespective of the fact whether carried out by the residents or non-residents. The monetary value of domestic product is termed as domestic income. The concept of normal resident helps to estimate national product. National product includes goods produced by normal residents irrespective of the fact whether performed within the economic territory or outside it. The monetary value of the national product is termed as national income. Now, the difference between factor cost and market price. While estimating national income and related aggregates, monetary value of the final goods and services can be estimated in two ways, at factor cost and at market price. Factor cost refers to all factor payments made by the producing units to the factors of production, land, labor, capital, entrepreneur for rendering productive services in the production of goods and services. It is called factor cost because it is cost of the production firm towards factors of production in the form of rent, wages, interest, profits, etc. Market price is the price at which commodity is sold in the market. It is the price what the buyers pay for the commodity. Market price is sum total of the factor cost and net indirect taxes. So market price is equal to factor cost plus NIT. Now, domestic income and national income. Domestic income is money value of all final goods and services produced within domestic territory of a country during the period of 1 year. If net factor income earned from abroad by a normal resident of the country is added to it, it becomes national income of the country. Simon Kuznets defines national product is the net output of commodities and services flowing during the year from the country's productive system into the hands of ultimate consumers or into the net addition to the country's capital goods. It is the sum total of domestic income and net factor income from abroad. The national income is equal to domestic income plus net factor income from abroad. Now, what is NFIA? It is the difference between factor income, rent, interest, profit, wages earned by normal residents of a country from the rest of the world and factor incomes earned by non-residents in the domestic territory of the country. It may be positive or negative. If receipts are more than payments, NFIA is positive and vice versa. Net compensation, net income from net retained earnings of employees plus property of resident companies, net compensation of employees, entrepreneurship abroad. First is net compensation of employees. It is the difference between compensation of employees earned by normal residents of India from abroad and compensation of employees earned by non-residents in India. Second is net income from property and entrepreneurship. It is the difference between rent, interest, profit and royalty earned by normal residents of India from abroad and similar payments made to non-residents in India. Net retained earnings of residents companies abroad. It is the difference between undistributed profits of resident companies abroad and foreign companies in India. Now, factor payment and transfer payment. National income includes only those income or payments which correspond to flow of goods and services. In an economy, there are two types of payments made. These are factor payments and transfer payments. Factor payment is made to factors of production in return for rendering factor services. For example, rent, wages, interest and profit, factor incomes earned by factors of production, and factor payments made by an entrepreneur to factors for their services are in fact the same. All factor payments are included in national income because there is corresponding flow of goods and services in the economy. Transfer payment received without any corresponding good or services. This is called unilateral payments. For example, old age pension, scholarships to students, unemployment allowances, charity, etc. These payments are received without making contribution to production. They are not included in the national income of the country because there is no corresponding flow of goods and services in the economy. Transfer payments can be current or capital. Current transfers are the consumption purposes, whereas capital transfers are for capital formation. So, after learning this topic, the students will be able to understand about the basic terms of micro and macroeconomics, stock and flow, classification of goods, meaning and types of investment, depreciation, capital loss, domestic and economic territory, and they will be able to clear their concepts in some basic terms like NFIA, factor, transfer payment, etc. Thanks.